Do you often wonder how to start investing in the stock market? Are you worried about the complex terms and strategies that seasoned investors talk about? If so, you're not alone. Many people feel overwhelmed when first approaching the stock market, intimidated by what they don't know. But here's the good news. The stock market is not as complicated as it may seem. And with the right guidance, you can start investing with confidence. So let's break it down step by step to help you get started on your investment journey. Step 1. Learn the basics. Before you dive into the world of stocks, it's important to grasp the fundamentals. At its core, the stock market is a place where people buy and sell pieces of ownership in companies known as stocks. When you buy a stock, you become a shareholder, owning a small portion of that company. So why should you care? Well, when the company does well and grows, your investment can grow too. But if the company faces challenges, your investment could decrease. It's a bit like owning a piece of a pizza. If the pizza shop does well and expands, the value of your slice might go up. But if the shop struggles and shrinks, your slice becomes less valuable. However, here's the magic. The stock market allows you to own tiny slices of many pizzas from all over the world. It's making it possible to build a diverse and potentially valuable investment portfolio without having to own entire businesses. That's the beauty of the stock market. Now, obviously, this analogy is quite simple and doesn't cover all the complexities, but hopefully it gives you a basic idea of how the stock market works. Step 2. Open a brokerage account. Once you have a basic understanding of the stock market, the next step is to open a brokerage account. Think of this as your gateway to the market. It's like a bank account specifically designed for buying, selling, and holding investments like stocks. You can choose from many online brokerages, each offering various features, fees, and platforms. When selecting a brokerage, look for one that suits your needs and offers a user-friendly experience. Research different options, compare fees, and read reviews to find a reputable platform that aligns with your investment goals. Each brokerage has slightly different offerings, but they all serve the same function of allowing you to buy and sell stocks. Some popular choices include TD Ameritrade, Vanguard, and Charles Schwab, but there are many others. Do your research to find the best fit for you. Opening an account usually involves providing personal information, linking bank accounts, and setting up security measures. Once everything is set up, you'll be ready to deposit funds into your account and start exploring the world of stocks. Step 3. Understand the different types of stocks and investments. The stock market offers a wide range of investment options. Familiarizing yourself with the different types can help you make informed decisions. Let's start with individual stocks, which are shares of ownership in a single company. For example, if you buy stock in Apple, you become a part owner in that company. Then we have exchange-traded funds, also known as ETFs. Imagine a basket containing stocks from various companies. That's essentially what an ETF is. ETFs allow you to invest in a diversified portfolio with a single purchase, providing exposure to multiple companies within a specific sector or the entire market. Index funds are similar to ETFs in that they hold a collection of stocks, but they are typically structured differently and have lower fees. They aim to match the performance of a particular market index, such as the S&P 500. Mutual funds, on the other hand, are actively managed, meaning there's a team of professionals making investment decisions to try and beat the market. While mutual funds offer professional management, they often come with higher fees compared to index funds or ETFs. Blue chip stocks refer to companies that are well established and have a history of strong performance. These are often large, well-known companies that dominate their industries, such as Johnson & Johnson or Coca-Cola. Growth stocks, on the other hand, are shares in companies that are expected to grow at a faster rate than the overall market. These companies are usually in emerging industries or have innovative products and services. Investing in growth stocks carries more risk, but also has the potential for higher returns. Finally, there are dividend stocks, which are issued by companies that distribute a portion of their profits to shareholders. These companies typically have a history of paying dividends regularly and are considered more stable and reliable investments. Understanding the different types of stocks will help you decide which ones align with your investment goals and risk tolerance. Whether you prefer the stability of blue chip stocks, the growth potential of growth stocks, or the passive income from dividend stocks, there's a wide range of options to explore. Step 4. Research before you buy. Now that you have a basic understanding of different stock types, it's crucial to conduct thorough research before making any investment. Don't just jump in blindly. Take your time to learn about the companies you're interested in. Look into their financial health, past performance, and future potential. A great place to start is by checking out the company's website and reading their latest financial reports. These documents provide valuable insights into a company's revenue, expenses, and overall financial stability. Additionally, you can look into their history of dividend payments, if that's something you're interested in. Reading through the company's annual report will give you a comprehensive overview of their operations, management team, and future plans. It's like reading a company's diary, allowing you to better understand their strengths, weaknesses, and future aspirations. Moreover, stay updated with the latest news about the company by following them on social media and subscribing to their newsletter. This way you'll be among the first to know about any major developments or announcements. Remember, knowledge is power. The more you understand about a company, its products, services, and future prospects, the better equipped you'll be to make an informed investment decision. Take your time, do your research, and invest wisely. Step 5. Start small and practice patience. One of the most important things to remember when getting started in the stock market is to begin with a small amount that you are comfortable with. Don't feel pressured to invest a significant portion of your savings right away. Starting small allows you to dip your toes into the market and gain experience without risking too much. As you become more comfortable with the process and develop your investment strategy, you can gradually increase your investment amounts. But it's crucial to remember that investing in the stock market is a long-term game. Avoid the common mistake of trying to get rich quick. Instead, focus on consistency and patience. 8. The stock market can be volatile in the short term, but over the long term, it has historically shown positive growth. By staying invested and avoiding impulsive decisions, you'll be better positioned to ride out any market fluctuations and potentially benefit from long-term growth. Remember, slow and steady wins the race. Start small, be patient, and trust the power of long-term investing. Step 6. Manage risk. While the stock market offers opportunities for growth and financial success, it's essential to manage risk effectively. Here are some tips to help you mitigate potential risks. First and foremost, never invest money you cannot afford to lose. Only invest funds that you have extra and won't need for immediate expenses. This approach helps you stay rational and prevents you from making hasty decisions driven by fear or greed. Next, diversify your portfolio. Instead of putting all your eggs in one basket, spread your investments across different sectors, industries, and asset classes. This approach reduces your exposure to any single investment and helps you navigate market fluctuations more effectively. Additionally, consider using limit orders. A limit order is an instruction to buy or sell a stock only if a specific price is met. This can help you avoid overpaying or selling your stocks too quickly during market downturns. Finally, keep an eye on your investments. Regularly review your portfolio, track your holdings, and rebalance as needed. This practice ensures that your investments remain aligned with your financial goals and risk tolerance. By following these tips, you'll be better equipped to manage risk and protect your financial well-being as you navigate the stock market. Remember, while the stock market holds tremendous potential, it's essential to take a balanced approach that considers both opportunities and risks. Stay informed, stay focused, and stay resilient. There you have it, a breakdown of how to start investing in the stock market. Hopefully this guide has demystified the process and shown you that it's not as daunting as it may initially appear. Now that you have a roadmap, it's time to take action. Start by educating yourself, then open a brokerage account. Diversify your investments and do your research before buying any stocks. Remember to start small, be patient, and manage your risks effectively. With consistent effort and discipline, you can build a strong investment portfolio and pave the way for a brighter financial future.